Hey, good afternoon, everybody. Dennis Mattern with CreativeOne. I am so happy that you are joining us today. It is that time of the month. It is the second Tuesday. It is 3 o'clock Central, and it is on this day, on this time, at this hour, Kevin.
We are the old faithful of the index webinars, Dennis.
That we are. This is the webinar. In case you're confused where you're at, this is the webinar where we walk through the CreativeOne Index Performance Report. I say we. I'm going to refer to my partner in crime here, Kevin Cloud, Chief Actuary, Product Actuary here at CreativeOne, colleague, partner in crime. Kevin, welcome, sir.
Happy to be here. Very happy to be here, Dennis, like always.
Awesome. Okay, couple things. Let's do a couple housekeeping items. One, if you look to the bottom right corner of your screen, you're going to see a blue box. It's a chat box. And if you click on that, if you expand it, I am looking right at the same thing you're looking at. So one, if you have any questions, if they fit the flow, we'll ask it right then. If not, we'll save it towards the end. Just a note, if you type anything in chat, everybody sees your name. So be kind, of course. Don't chat anything you wouldn't want your mom to see. A good thing there. But if you're feeling bashful and you do have a question, if you type it in the Q&A, only I see the Q&A and I will be your proxy. From there, though, I do want to point out that we are recording, so you can fact check us later at your leisure. And then also the report that goes out, I will be sending that out again to everyone that's on here to make sure that you have your copy. Now, let's dive in, Kevin. So, sorry, buddy. Sorry. What we're going to take a look at, we are going to take a look at this beautiful index performance report. We put this together every month, Kevin and his team. It is fantastic. And in fact, recently we've added to it. And when I say we've added to it, what I'm referencing is the fact that, one, you have the ability on the first page to see the benchmark, the indices, and go back in time 1 month, 3 months, 9 months, going back years. But then also you have the ability, we get into the individual indices themselves. You have the ability to click on each indice. That'll take it to to their landing page so you can get all the data you need. Next column, you're going to see what carrier actually has that indice. Is it available currently? And the reason that we do that, there's one or two that are very important indices that come up all the time that are still in play but not available going forward. We want you to know that. You see the monthly numbers, and then you go over to the right side of this report, and what you're going to see is you're going to see the constituents. Are you looking for large cap? Are you looking for exposure to bonds? You can actually get in there, and then all the way to the right, super, super important, what is the volatility measure? Kevin, did I miss anything?
You didn't miss a thing, but I actually have a question for our audience. Like you had mentioned, there's a few indices here that are no longer available that we've left on there, sometimes because they're important to, or we believe they've been important. They've had lots of premium allocations over time. So we think that our audience is interested in seeing how they're doing. My question, actually, it's a two-part question. Number one, should we continue to show those indices? Number two, some of the indices that have been discontinued, we've also discontinued from this report and removed them. Should we add them back in? I'm curious. So there's a few that have been in indexed annuities. They might have been not quite as popular as some of the ones we left in, but they have been discontinued. Should we add those back in? It's something I've been thinking about. Is that something our audience would like to see? Please use your chat box or questions as Dennis has outlined. I would love to hear your opinion.
I would love to hear it too. Okay, so here's what we're going to do, though. So in the next couple minutes, here's what we're going to cover. We're going to talk index performance. We're going to talk real world returns. This is like the literal only place where you're going to hear real world returns across a lot of products. Normally, you don't get that because no one wants to go on record. And then we're going to talk a little bit of analysis.
Sounds perfect. Yes, you're right. I mean, we talk about a bunch, but for my money and I guess for our audience's time, which is money, real world returns where it's at. That's the thing we're providing. I don't think you're going to see anywhere else except possibly on client statements.
Where the rubber meets the road.
Exactly.
All right, so let's dive in. So we're going to take a look at 1 year results. Now, a couple things before, and I'll set the table. Kevin's coming in for cleanup. But what you're looking at, we'll start up in the top left. You're going to see the name of the index, the indice. You're going to see the gross change. Now, gross change on that indice for the 12 months ending July 31st, 2025. Close of business July 31st. Then you're going to see the strategy. Then you're going to see the factor, and then you'll see the credit. Now, you might be saying, hey, I'm not seeing anything in several of these. I just see a zero. And you are correct. And that is because The index itself, gross return negative. So you know what? The strategy was a par strategy. You know, zero is your hero, which is a phrase we need to remember because it's not always gravy time, right? Zero is your hero, but why do the math if there's no math to be done if it's going to be a zero? So with that being said, I always like to take a glance, and I'm going to take a pause and get a breath and let you talk, Kevin. As I glance at it, my perspective, if I'm looking, it looks to me like we are at about 30% of the indices on this page were positive.
I'd say that's probably about right. Not stellar performance from a lot of the indices, and we're going to cover some of the whys here in a little bit. Actually, the one big why, in my opinion, I do think that there are some indices that continue to perform very, very well. I think we consistently have an issue of a lot of these indices are perhaps older technology that aren't really built for today's market. I will tell you, there's a few on here. So you talked about our criteria, Dennis. Our criteria is it has to be available now, had to be available also 12 months ago. There's a few here that are going to be dropping off soon. So I think we're starting to see some of the perhaps survival of the fittest going on, where some of the indices that weren't built to be responsive in today's economic environment are no longer going to be available going forward.
That's interesting. So a little bit of a culling of the herd, if you will.
That is a very North Dakota way to put that, Dennis.
Thank you. What generation of indice would you say we're on now when it comes to vol?
Oh boy, I don't know if there's like an official Gen X, Gen Y, millennial type of outline, but I mean there were the very first generation indices. Then there was a second generation, really, when you started to see some of the, I would say, the excess return mechanisms were introduced. And I would say now what we're starting to see is the intraday types of valuation. So in my mind, those are probably the three main jumps. So we're probably in Gen 3.
Gen 3.
But an expert or historian, perhaps more versed than I, might have a different opinion.
This is your opportunity to name something and then take credit for. Somebody had to say, hey, that's Generation X. Okay, so we're looking at the annual returns, and we've got it down to here. Talk to us.
So naturally, we want to take everything we showed you on the previous page, kind of distill it and show you which indices and index strategies actually provided the best credits over the trailing 12 months, because index returns are great, index credits are even better, and that's what we want to see. So what we have here is the 12 months ending July 31st. You can see the big performer was the S&P 500 futures ER strategy. So this is an index, and we've mentioned this before, but I think it bears mentioning again. This is an index that does not have a volatility control measure on it. This index only has an excess return mechanism, which basically means it's taking interest out of the equation when they calculate the option prices on these indices, and they do that by having the daily returns be the amount over the risk-free return. So without getting too much into option pricing, that basically removes interest rate fluctuations from option pricing, makes the option prices more stable. Anyway, no volatility control. We're going to see why that's a big deal in a minute, but that's why that index has performed very well. Below that, you see the Mark V, which we covered in a fair amount of depth last month. That has a gold allocation, which gold continues to do gangbusters. So that certainly has helped that. And I think in one way or another, we've covered most of these indices over the last several months. So a lot of them have been reflective, but that's what we see. If you go forward one more slide, unless you had something to add.
I was just going to say, as a reminder, if there's any, as you're watching this, if there's any indice you ever want us to pull the curtain off of, rip the hood up, flip the hood up, and take a look what's in there, let us know, and we will dive into it on a future broadcast. But keep going, friend.
Yeah. So this was the 12 months ending June 30th. So this is what we saw last month over on the right. On the left is what we're seeing this month, and you can kind of see the distinction. So the Mark V and the PIMCO balanced pulled back just a little bit, but the S&P 500 futures index continues to be pretty strong. So we're gonna do this. We're gonna watch those, not just the indices that perform well, but the strategies that perform well and provide credits. But I think you and I have talked about how volatility control has responded during the last 6-ish months, has really impacted the rates that these indices and strategies are returning. And we're gonna examine that again in just a moment. But I think it's hugely important, and I think it's something you should be prepared for, because the impact, we're going to continue to feel that kind of like a ripple for the next 12 months.
I like it. I do have to say, so going in some of what we're going to cover here on this next slide, I was just at a conference. There was a couple S&P 500 executives, and they were talking about something we've talked about on the last two episodes of this webinar, which was the responsiveness of vol control to those hiccups, and then being able to take advantage of the ups.
So what do they have? Anything you can add? Anything you remember? I'd love to hear what they say. I wish I could have gone to that. That would have been interesting.
For the most part, that was 30 minutes out of a very long 2 days. So be careful what you wish for. But what they were talking about, they went through on the indice that they were launching, specifically talking about how it
is more responsive.
Responsive. But I will say, I do not think that they quite understand what the field has to say about vol controls and their concerns. But we'll save that for another day.
Yeah, we'll have to debrief on that. Anyway, so we have 3 things going on here. Our white line is our S&P 500 over the last 12 months. So as you see, S&P 500 takes a big dive in spring of 2025. Everyone's concerned about tariffs. No one knows what's going to happen. Everyone's concerned. Then it starts a pretty significant, quick rebound. And basically over a 4-ish month period goes back to break even. So that's the S&P 500. The orange line is the S&P 500 average daily risk control, 10% volatility control level price return. That means there's no excess return mechanism. The only control on this index is the volatility control. And so what we're talking about right now is the responsiveness. So then the blue shaded area in the background, that's the level of volatility. The more volatility, the less responsive the volatility control index is going to be with respect to its underlying index, in this case, the S&P 500. So you can see what's going on. Go to our far left. We actually had a pretty quick dip there at the beginning of the 12-month period we're examining. S&P rebounds. You can see actually it even started at the beginning of this 12-month period. The S&P dropped and then came back up. So it was down, looks like about from the beginning of the period, like almost 7%, but then it rebounded up 2%. Our volatility control index went down and it came back up, but it didn't come back up as much as the S&P 500. It's basically flat over that first couple months, whereas the S&P 500 took a drop, but it was up 2.5% over that same period. Then you can see other drops. Volatility becomes fairly moderate, as you can see. So more or less, our risk control index is following along with its non-risk control underlying index. And then spring of 2025 happens. You can see in some ways the risk control index did what it was supposed to do, right? It limited the losses. It said, okay, this is volatile. Things are dropping. I'm getting out. The issue is that, like we've talked about, so underlying index drops a bunch, volatility spikes. The vol control index says, I don't want no part of this. But when there's a very, very quick rebound, the volatility control index still sees a bunch of volatility and says, I'm still not going to be following this thing because there's still too much volatility out there. So in a high volatility rebound environment, which is exactly what happened, we have an S&P 500 index that recovers, and we have a vol control index that is recovering, but doesn't recover nearly as quickly. But as you can see, basically for the last 2-ish months, it's kind of followed in lockstep. And if you look at the trailing 1 month, actually, the two indices, the risk control and the non-risk control, are actually very, very close.
I think that when you look at, I think this slide from, let's call it April of 2025 to June of 2025, I think should be studied by everybody that is considering that is interested in vol control, so that they don't get confused or they understand, because exactly what you said, the market, you see the down, the big bang, you got a big down. The vol control does what it's supposed to do. Like, hey, let's smooth things out. We're going to protect you. And then the market spikes, and then anybody who sold a vol control is like, I don't understand why it's not going up. And the reason being is every signal that vol control indice is looking for that says danger Will Robinson, that's what it's saying. I'm going to work on my analogy for this one. There's a story here, but that's really what's going on. Is all indication is things are crazy. The vol control is doing exactly what it's doing, and yet a lot of people are like, I don't understand why this thing's not performing.
So here's the question. This is a very specific economic environment. A big drop, and then a big bang back up. Clearly, this volatility control index and a lot of the volatility control indices didn't respond well to it. But this is one specific situation. What if we're in another situation where things don't work out like this? There's a big drop, and then there's not the quick recovery. In that case, the volatility control mechanism could actually be advantageous. So we have such short memories, and I understand that people are generally unhappy with this kind of performance, and I understand entirely. But that being said, I think you have to accept the good and the bad and understand you're going to have scenarios like this where it might not work out as well. If you don't like this and this is a deal killer for you, well, then you've already answered your question. But if you understand that there could be economic environments when it does make sense, I think that you have to consider that.
And the beauty of the modern fixed indexed annuity, you've got multiple options inside the same product.
Yeah, bang. For sure. I really hope. Just a general philosophy, and I hope our audience thinks about this, and admittedly you're in the field and I'm not, but a mix of indices, both vol control and not, is probably appropriate for your client's FIA menu.
I think so. Let's talk to you, Kevin. So again, the same parameters, a couple things though, that the one that I always want to remind everybody, again, index, gross change, strategy, factor, credit. Key thing here, these numbers that you see on here are the 2-year return. So 2 years, 24 months, ending July 31st, 2025. So those are not annualized numbers. That is the gross return over that 2-year period. And again, when I look at this one, it looks to me about 50-50, I would guess, to the positive.
I think so, that's about right. And I think that even though the 3-month period we talked about in spring of 2025 is a smaller portion of the returns for the 2-year indices, I still think they experienced the same problem. You had that quick down by the S&P 500 and other equity markets, a quick back up, and it doesn't. These are going to suffer in that same way. They're not going to have that responsiveness. I will also tell you something that we don't necessarily see here, but you could have seen in the 1-year slide. We're kind of obscured by the fact that specifically U.S. large caps and tech type companies continue to have outsized performance. There's some other indices that don't. If you follow the small and mid caps, those have been basically flat to down over the last year. So to the extent that some of these indices reflect the smaller cap or the mid cap index, which there are a few, that's definitely going to have a drag on performance.
Absolutely. All right. Well, let's talk about the good.
So we always love to look at credits because, again, those are what matters. The interesting thing I see here, the very top index, something we just talked about, S&P 500 FC. FC standing for fast convergence. This is an index with a volatility control mechanism that measures volatility and adjusts and can rebalance in the middle of the day, intraday, as they call it. And you can see that performed very well over a 2-year period. Not only did the index itself perform well, it had a factor above 100%. So you landed with a pretty decent credit. The Mark V, like we've talked about, is getting the advantage of gold, which is, it's done well over 1 year. It's done really, really well over 2 years. So
Mark V has a fair amount of track history, doesn't it? I feel like that's been around for
that's been around it's definitely pre-COVID. I can't remember exactly when. It might even be approaching 10 years.
Wow.
So you can go down, you see some other indices we've covered, the Shiller Barclays Global, you see the City Area Index, which actually has a fair amount of, I believe it has a fair amount of exposure to like US tech. So that's the reason why that has performed very well. You see NASDAQ FC, which is the brethren of the S&P 500 FC index that we reference above. And then on the right, we see what was going on last month.
Boom.
Last month, the 2-year period ending on June 30th.
Again, be interesting to see. I've said this a million times. Be interesting to see how much emphasis and how much flow goes to 2-year returns after a fair amount of advisors kind of had their nose bloodied.
I will be interested in, again, a question for our audience. Do we want to continue to even cover 2-year results on this on this webinar. So if our audience has an opinion, I'd love to hear it. I don't think the allocation to 2 years have been especially significant. That being said, at some point that might change, or the importance might change, or the performance might change, and perhaps we need to let people know when that happens. In case you've been out of the 2-year game, maybe at some point in the future it will make sense to get back in.
Kevin, you talk for just one more second, because I'm going to throw the poll question. I need.
Oh, okay, perfect. So running down what we see as being a pretty good performer. We talked about this in the area, the NASDAQ FC, which again, everyone knows NASDAQ, that is tech based, but again, it uses that intraday volatility measure to adjust the allocation to the underlying index. PIMCO tactical balance, that's been an index that's performed pretty well. Historically, we see it over there on the right. So it's performed well in June, but also in July. So it continues to perform well. PIMCO Global Optima getting some international exposure there. So it's really a broad range of indices, but each of them has a specific reason why they performed well. In some cases, it's because they have the right asset mix, like the Mark V. S&P 500 has a newfangled technical term, volatility control level. And then finally, we've discussed these in the past, but a few indices have just been able to get out of the way of that 3-month period that we talked about, and so they were kind of undaunted.
Now I do have so the poll question is out there. So let your vote is your voice here, but so far it's leaning towards no,
not interested. Don't waste my time.
Not as interested.
Interesting. All right, we might pare this down. Maybe we'll just we'll bring it up intermittently, but not every month.
We'll see. You still have to eat your broccoli, you know. All right, let's talk about Treasury yields.
Love to talk about interest rates. I feel like it's been in the spotlight for a long time now, as the executive branch and the Fed kind of butt heads on the direction of interest rates. You can see, so we reflect 3 rates here: the 10-year, which is the darker color in the background, the 2-year, which is the kind of the magenta line, and the 3-month, which is the light pink. So a few things going on. Number one, you can see on the far right, you get a sudden drop on the 10-year and a sudden drop on the 2-year. We had a jobs report come out that day that basically reflected some softening in the labor market, which leads everyone to believe that a rate cut is coming sooner rather than later from the Fed, possibly as early as September. That is tempered because today, Dennis, the inflation report came out. I don't know if you saw it or not, but inflation is still holding steady. As a matter of fact, core inflation ticked up a little bit this month. So the Fed kind of finds itself in a jam. Jobs report might indicate it's a little softer than it has been. Not soft by historical standards, but softer than it has been. Does that mean cut rates a little bit? But the inflation report would definitely indicate no cut is needed. So I don't know what the Fed's going to do. There was some dissent amongst the Fed during the last open market meeting. So we'll kind of see what happens. If I had to guess, they dropped 25 basis points. And if I also could opine on that, I think that's a mistake, but we'll see. I think inflation is still, it's still present. I think the threat of higher inflation still looms. We have seen, the other thing is dropping that rate could actually exacerbate inflation to a significant degree. It might actually increase the longer rates as people are concerned about long-term inflation. So we could see a steepening of the curve. The shorter end goes down with the Fed going down, but the market views that as long-term inflationary, and so 10-year rates go up. But we shall see.
We shall see. It sounds like I'm not refinancing my house anytime soon.
You are not. What you've got is probably what you're going to get. Even so, my opinion, either mortgages stay where they are or they drop the short rate, and it might actually raise long-term rates. I don't know. We'll see. I've been wrong before, but we can go to the next slide real quick where we can kind of see where inflation is.
Before we go to the next slide, I do want you all to know that we are 50-50 on keep covering the 2-year reset. So if you haven't,
there's like a horse race going on.
If you haven't voted, now is the time. Every vote counts. What do we got here?
So this is just the inflation numbers that came in today. So this is hot off the press. We saw core inflation, which is the dotted light blue line, tick up a bit to 3.1. It's not a great number. And then you see all items, the traditional CPI coming in at 2.7, which is still not a low number. It's lower than it has been. You see how things spiked earlier this decade, and they've moderated, but the stated goal of the Fed is around 2%, and we're not really anywhere close there. And I don't think we're going to get close to that absent a shock or a raise in interest rates, which I don't think is going to happen. So I think I don't see this turning anytime soon, but we'll see. My opinion, and I always reserve the right to be proven wrong later, Dennis.
There you go. A big solid maybe. Just kidding. Okay, so we're at the end. So a couple things here. So if you have a question you want to throw out to us about what's going on with different indices, anything you're curious about, let us know. Chat's available. Q&A if you're feeling bashful. Boom. While we wait for just a second, a couple of reminders. One, we do this webinar the second Tuesday of every month at 3 p.m. Central. We always record it. The recording is always available. We get the copy of the report out to you. I will be getting a copy of the report out to you. Even if you already got it from me this afternoon, I'm going to do it twice. Just to be thorough, just to be effective. Share it with a friend.
Measure twice, cut once. That's
there you go. There you go. We'll do that. And then, gosh, if there's any indice that you want us to pull the onion back and take a look at, we would love to do that. Kevin, I think we might be question free today.
All right.
We'll just call it.
Well, I appreciate those that took the time to answer our poll question. We'll continue to evaluate that. And like Dennis said, we want this to be the best possible use of your, 15 to 20 minutes every month, second Tuesday. So if you have input on this webinar or on the index report that we send out, please do not hesitate.
I agree. Well, with that being said, on behalf of Kevin Cloud, on behalf of CreativeOne, I thank you for taking time out of your day. Oh, that's one other thing. When you want to have the discussion about an index, if you want to get into the weeds, our sales teams have all the software. We've got internal tools for them to have that conversation of why this indice, why now, why you might like it, why you might not, and have that conversation with you. So now, with that being said, I say thank you, and go have a great rest of your day, and we'll see you next month.